Oh, yeah, it is. It'll look better. You put this cord on that, and just put the cord under the jacket. There you go. Great.
Thank you.
Danny used to be in TV, so she makes sure that we always look. She's my ace in the hole. She knows how to adjust all the buttons and stuff.
Good afternoon. Good afternoon. And welcome to the November meeting of the Economic Club of Pittsburgh. My name is Risa Kumazawa, and I'm the president of the organization, as well as Associate Dean and Associate Professor of Economics at Duquesne University. We have a very special speaker with us today, Beth Hammack, who serves as President and Chief Executive Officer of the Cleveland Fed. Beth is responsible for all the bank's activities, including those related to monetary policy, bank supervision, and payment services. She has more than 30 years of experience in finance, capital markets, and risk management, as well as service on several advisory groups in the U.S. Department of the Treasury and the financial industry. Most recently, she was co-head of global financing at the Goldman Sachs Group, Inc., where she was a member of its management committee. Beth has worked closely with U.S. policymakers as chair of the Treasury Borrowing Advisory Committee and as member of the Financial Research Advisory Committee and the Treasury Market Practices Group, the latter of which aims to advance financial industry best practices. She is the chair of the board of the nonprofit Math for America, a member of the University Hospitals Board of Directors, a member of the City Harvest Board of Trustees, and a Greater Cleveland Partnership Board observer. Please welcome Ms. Beth Hammack. Okay, so we have a fireside chat format today, so I'll be moderating the questions. Beth, my first question to you is, we've heard a little about your journey in the introduction, but tell us about yourself and what was your career path and how did you end up leading the Cleveland Fed?
Well, thanks so much for having me. First of all, it's great to be here in Pittsburgh and in the region. I try to make it here once a quarter to visit. We have a branch in Pittsburgh, as we do in Cincinnati and our main office in Cleveland. So as you said in my biography, I spent 3 decades in finance. And one of the most rewarding things professionally that I got to do during my career was serve on some of these advisory committees. And so it put me in the room with members of the Treasury Department, members from the Board of Governors, and I got to understand and appreciate some of the challenges and hear the questions they were asking. And I realized at some point in my career as a finance professional, you spend a lot of time thinking about what the Fed will do. And at some point it became a more interesting question to me, not what would they do, but what should they do? And I wanted to make that shift from being someone who was a policy watcher to being a policymaker. And so this has really been, for me, just an incredible highlight for my career, and just really an honor and a privilege to be able to offer all the things that I've learned over the 3 decades of my time and try to help bring that to bear. I moved to Cleveland from the New York area where I had been before, but we have roots. My family has roots in Cleveland. My husband grew up there, and his family's still there, so it's nice to be in a place where we have friends. And I grew up in the Commonwealth of Pennsylvania, although at the very other end of the state, outside the Philadelphia region.
Okay. You're here in Pittsburgh today, and this is your 3rd visit, I believe, since you started about a year ago. Why is it important for you as a Fed bank president to travel to different cities and towns?
So the 4th Federal Reserve District, which is what Cleveland represents, is all of Ohio, Western Pennsylvania, Eastern Kentucky, and just the northern panhandle of West Virginia. So that's the region that we encompass. What I love about this region is that it's really a microcosm of the country. And so when you look across the district, you've got strong representation from eds and meds, whether it's in the Pittsburgh area or in the Cleveland area that's got leading hospitals in both areas and leading universities. You've got agriculture, because there's a variety of rural parts of the state. You've got real roots in manufacturing, and also the transition from manufacturing to the services sector and the emerging technology growth that you've seen. You also have energy production. That's a big focus here in the Pittsburgh region, but also in other parts of the district, that's another place that things are focused. And so it gives me a really good bird's eye view of many different segments of the economy and how they're performing. And so for me, one of the really important parts of the job is in trying to set monetary policy, which is only one of 5 things that we do at the Fed, but it's the one that most people pay attention to. It's really important to have a good view on how the economy is performing and how it's performing for everyone. So the official sector data that we get from the BLS and from other official sources gives us good aggregate viewpoints on things, but I always try to supplement that with both private sector data and then conversations with businesses and local leaders, because they'll give you more of a different feeling of how things are going. And it really, to me, it helps the numbers to come alive, and it helps to really put a face to what's happening. And over the past 45 days, while the government has been closed, it's been really one of the primary sources that I've relied on to get a read on how the economy is faring. And I find it at almost all times that the stories, the anecdotes that I get from these conversations tend to be leading indicators of where the economy is headed. And so I find that, putting that whole picture together, the official sector data, the private sector data, and then the anecdotes, conversations, and stories that I get from these small group meetings really helps me to have a good understanding of where the economy is.
What does the Cleveland Fed do to serve Pittsburgh and Western Pennsylvania?
So we have a branch in Pittsburgh, and Russ Mills, who's oh, there he is. He's up there. Who's our regional executive is here. We try to stay really well connected in the region and try to understand what's happening. And we have a host of data that we put together at the Cleveland Fed. And so whether it's analyzing, different regions, the performance, the challenges that you're seeing in each of those areas, we really try to share the data that we have and share the insights that we have from the community. So one of the things that all 12 Federal Reserve banks do is we put out on the same cycle as the FOMC something we call the Beige Book, which is a compilation of all the stories and conversations that we've had with businesses and community leaders in our district to understand how they're faring. We at the Cleveland Fed have turned all of those stories into a set of indices that we call our SOURCE, without a U, a survey of regional and consumer expectations, regional conditions and expectations, thank you. And we put it out in an index. So what's great is that you can see the same data that I'm seeing in nearly real time. So we put that out so that the full community can see it and you can get different cuts of it as it may be of interest.
We hear about the Fed in relation to interest rates, but what else does the Fed do?
So the Fed has 5 main functions, and setting interest rate policy, monetary policy, is the one that we are certainly most well known for. That's the one that tends to get a lot of the headlines. But there are 4 other key functions. The next one is financial stability. That was really the reason for our founding, was in 1913 after a number of different panics trying to make sure that you had a central bank who could be the lender of last resort and it could survey the landscape. And so today we still spend a lot of time surveying the landscape to understand where there may be pockets of emerging weakness or things, overheating that are worth paying attention to. Closely related to that is our responsibility to supervise and regulate the banks. So regulatory policy is set by the Board of Governors in Washington, and then the supervision is delegated to each of the 12 reserve banks. And so within the Cleveland Bank, we supervise about 250 financial institutions, from banks to credit unions to some insurance companies, to try to make sure that they are strong and safe. And by having a strong and safe banking system, that makes sure that we have credit flowing through all the different sectors of the economy. The 4th function that I'll mention is consumer protection and community development. So we work with the banks in the region, we work with community organizations in the region to understand what some of the key challenges are and to help make sure that we are identifying what those issues are, helping to elevate and share best practices and new ideas. So we don't set community policies, but we can study problems, particularly problems related to workforce development, housing affordability, or small businesses. Those are places that we tend to focus because those really help drive the economy. And so at the Cleveland Fed, we run a small business credit survey every year nationally, and it gets responses from more than 10,000 small businesses across the country. And it helps to inform us and our colleagues around the Federal Reserve System around how small businesses are faring, what they're doing, how their access to credit is, and how that's helping to support the economy overall. And then the last thing that we do is we help run the nation's payment system. And so that can be from something as granular as making sure you have fit currency in your wallet. So if you have a paper bill that you look at, it'll have a letter on it. Most often, if it has a D, that means it was ordered and processed by the 4th District in Cleveland. We also, in Cleveland, host all the payment receipts for the U.S. Treasury. So the Federal Reserve System as a whole serves as the fiscal agent for the U.S. Treasury, and different banks across the system play different roles. So the New York Bank helps with the auctions and debt issuance. In Cleveland, we help with receipts outside of tax receipts. And in Kansas City, they help with all the disbursements that happen through the system. And so we're working very closely with the Treasury Department to help make sure that they have the access to the payment rails and that payments are going out in the right form and fashion. Most recently, we've been shifting and focusing on instant payments, as that's been an increasing area of focus for consumers and businesses. And so the Fed launched FedNow a few years ago, which is our real-time payment system. And so that's continuing to develop. But we'll stay on top of other developments in the payment space as well.
So I just want to, we brought 2 tables of our students from Duquesne, so I hope you guys are learning what's important with the Fed. So I think the next question is something that we're all interested in, which is about the economy. What are you seeing and hearing as you travel around the 4th District, and what is your outlook for the economy?
So the U.S. economy has been remarkably resilient. We're coming out of this period of the government shutdown, and hopefully we'll start getting some new data. We'll get the September data. I'm not sure if we'll get October data, but as I mentioned, we're supplementing that with other pieces. When I'm out in the region talking with businesses, what I hear most frequently is that inflation is still too high, and it's been heading in the wrong direction recently. It's actually been moving up, away from our target rather than down towards our target. We have a dual mandate, so we focus both on the inflation side as well as on the employment side. The employment side is also being challenged in that we're starting to see some softening in the labor markets. We've had a really robust labor market over the past several years. Coming out of 2021 and the pandemic, it was very difficult to hire people. You had an extremely tight labor market, and we've seen that move to a more stable level. We're now right around 4.3%, which is right around my estimate of maximum employment. And so when I look at the economy overall, just looking at the data, is we've got maximum employment around 4.25. Right now we're around 4.3. On the inflation side, our target is 2%, and inflation's running around 3%. Now, some of that may be related to tariffs that have been implemented this year, but there is pressure and continued upward pressure in inflation in the services sector, and that's harder for me to see as being related just to the tariffs. And so when I look at the balance of where we are from a monetary policy perspective, and because both sides of the mandate are being challenged right now, I mean, this is a difficult time for monetary policy. But when I look at both of those things, on balance, I think we need to remain somewhat restrictive to continue putting pressure to bring inflation down towards our target. So when I'm out talking to businesses, I hear them thinking about their margins, how much have they passed on of price increases that they've seen, whether it's in goods, whether it's in insurance, which is an area that I hear very frequently, that prices are continuing to go up, whether it's in energy costs. They're thinking about how they can pass that on to their clients. And I would say that I generally hear that nobody wants to be the first one to raise prices. We were at community receptions in Columbus and in Cincinnati and talking with some business leaders there. And they're each feeling pressures in different ways. Some construction companies, grocery retailers, manufacturers, and many of them are seeing pressure both on the insurance side as well as on their input costs into the manufacturing products, into raw materials as well. And they're trying to figure out what can they pass along, what can they not. What I've heard from businesses is that they've actually absorbed some meaningful amount of the tariff pressures and the increased costs that they've had over the past 3 to 6 months, but they can't do that forever. And so they're going to have to start passing more of those costs into their prices. And so I expect that we will continue to see some elevated pressures and inflation into the end of this year and into the beginning of next year. And so again, that's what tells me that we should be leaning on that, somewhat restrictive stance of policy to make sure that inflation is still coming back to target. Now, I do watch the labor market closely. As we talked about, it seems to me to be broadly in balance, although there are some signals that we're getting that are certainly things that I want to watch closely. So whether that be the recent, very high-profile layoff announcements that we've seen, whether that be the headline payroll numbers that went from being in the hundreds of thousands per month to being in the tens of thousands per month, that's a pretty meaningful drop-off. But when you see that type of a drop-off, you have to unpack, is that coming from the demand side of the equation or the supply side of the equation? Given the very significant changes that we've seen in immigration policies in the US, it could be that it's coming more from the supply side of the equation. And so to me, the best statistic to encompass both sides of that is really looking at that unemployment rate. So that's why I'll be looking at the September data that comes out. I don't know that we'll get October data, but hopefully we'll have November data coming out as well in early December. And so those will be places that I'll look to see, is employment continuing to stay broadly in balance? Again, some signs of cooling over this recent period, but to me, generally broadly in balance. And so I have to weigh both of those things. Inflation that's missing by a full percentage point, employment that's missing by a couple of tenths right now, but again, looking at the trajectory of where we're headed, because the forecast is really what I need to be focused on.
Why is it important that the Fed as an institution be independent?
There's been a lot of discussions of Fed independence recently. Fed independence is critically important for making sure that we can deliver on those dual mandate objectives. So to make sure that we can deliver on stable prices and maximum employment, I need that when I and all of my colleagues walk into the FOMC policy room, that we are focused squarely on the data, on the stories that we're hearing, and on the experiences that the Americans are having with the economy, and we're using only those factors to help set policy to steer the economy to our dual mandate objectives. Politics should play no role, and does play no role, in setting of policy, and that's what being independent means to me, is that when I walk into the room, I'm squarely focused on the data and making sure that I'm making good decisions over the medium and long term to ensure that we're delivering on both sides of the mandate. And so having an independent central bank will deliver more stable, lower inflation outcomes, healthier employment outcomes over the long term. You see that most central banks around the globe are actually moving towards greater independence because you have so much strength that comes from those better outcomes with an independent central bank.
The Pittsburgh region is rapidly becoming a hub for artificial intelligence and data centers. What do you see as the opportunities for regions like Pittsburgh related to the deployment and implementation of AI?
Yeah, it's hard to go to a meeting with a company or a community organization and not talk about AI. It really is the hot topic in almost every room. And this is a really exciting technology, and what's wonderful is that the Pittsburgh area is at the center of it. Whether it's Carnegie Mellon University, whether it's all of the tech sector companies here that are looking at AI or robotics or other machine learning techniques, there's a lot of great innovation that's happening right here. And so I think it's a really exciting time. Anytime you have one of these new technologies, there's going to be a lot of promise and a lot of upside, but it could be a time of radical change and radical transformation. And so I think right now it's a little too soon to say exactly what the possibilities are going to be and how it will play out. If you go back and look in the late 90s, early 2000s, and look at how the internet had transformed things, you had a period where there was a lot of excitement, and you saw markets pricing in a lot of excitement, maybe getting them ahead of themselves a little bit. And then you saw things taper off as sort of not every company that just was internet attached was going to be able to continue to excel. But look at where we are now with the internet. And so we had this huge boom, a little bit of a correction. But if I'd told you in 2000 that the internet would be as core to your and fundamental to your everyday lives as it is today, I don't know that you would have believed me or understood that. And so it may be that as we're living through this AI adoption moment, companies, businesses, communities are figuring out how to take advantage of it, how to use it to help support and complement their work. And it may be that some of the valuations you see in the market may be getting out of themselves. They may not be. I don't know. Time will tell. But I do expect if this technology is as transformative as what I hear in these rooms, that you will see 20 years from now it having completely reshaped how we do things. I hear a lot from businesses, well, I hear a lot from communities that they're worried about being replaced by AI. And in my conversations with businesses, what I more often hear is not about replacement of individuals, but it's about helping to support the work of individuals. It's enhancing the experience of their employees. It's about making their employees work smarter, faster, provide better insights so you can have a better client experience, more targeted sales teams and analytics. And so I think that anytime you have these transformative technologies, it can be disruptive, and there's a lot of change that will happen. But I think there's a lot of possibility for how this can enhance the existing workforce and help to upskill and change the way that we're engaging in the work that we do.
Okay. Pittsburgh, like many regions across the Cleveland Feds District, continues to suffer from a stagnating to a declining population base. What have you observed in different cities around the 4th District that have led to positive momentum and successful collaboration?
When I'm traveling the district, I see a lot of collaboration between the private sector and the public sector. I see businesses who are very engaged, very committed to their cities and their regions, and helping to invest and make sure that the city can be as vibrant as possible. Across the 4th District, most of the cities are at a place where I'd say it's been low population growth. And so very often what I hear from businesses is actually they have a hard time finding workers because there just aren't enough people around. And so attracting and retaining young people to stay in the area is a challenge in many of these cities. What I think is fantastic in the Pittsburgh region that I see real innovation happening here. And I think because of the placement and the technology leadership that you have in this area, you're really well positioned to take advantage of these new technologies that are happening. And so, the focus on data centers, which different cities have different perspectives on whether or not they really want to commit to data centers. But I see a lot of excitement about the possibility here. And yes, it draws on energy resources and it draws on water resources, but it brings a lot of jobs through the development of those centers, through the building plans, and through continual upgrades that need to happen over time to keep the technology fresh. And so I think there's a huge upside and possibilities in this region, particularly because of that. There's a lot of other exciting investment going on, whether it's U.S. Steel and Nippon Steel's billion-dollar investment. That's really exciting, and then some of the commitments to continuing to develop in the energy sector here that we see, whether through Duquesne or through Westinghouse. I think there's some different places that there are some exciting things that are happening.
Thank you. Now we'd like to open up questions to the audience. So there's a microphone right there. We have about 15 minutes for questions from anyone.
And we particularly like student questions. Because the students are here to learn and for me to learn from them. A lifelong student.
That would help.
There you go.
I learned something already. Thank you very much for being here on behalf of the club. I'm Stuart Hoffman with PNC. Very informative discussion. hopefully we'll hear more from our students. You said at one point you think policy needs to remain restrictive. So I don't want to get too wonky, but I did want to ask you what your thoughts were about kind of the neutral Fed funds rate. Obviously, there's the range and that we see in the dot plot or the report that will come out again in December. So the funds rate now is in the high threes. And I just was wondering if you could maybe talk a little more about your perception of where neutral would be and why you feel you need to be, at least in that perspective, a bit on the restrictive side.
Yeah, thanks for the question. I think that monetary policy right now is barely restrictive, if at all. I think we're pretty close to the neutral rate. My estimate of neutral is higher than, it's towards that higher end of the range that's published in the Summary of Economic Projections, or the dot plot, as people like to call it. And I base that on a couple of things. I look at the theoretical models, and my colleague John Williams has, part of the seminal model, the Laubach-Williams model for R-star. That estimate, if you look in the Laubach-Williams model, has been trending upwards over the past several years. I look at how the economy's been performing. So one of the things we say about R-star, the neutral rate, is we'll know it by its works. When I look at how the economy's performed, I see spending continuing to be reasonably strong, consumption is good, the GDP numbers are healthy. That doesn't feel to me like an economy that has an overly restrictive set of policies. And then when I look at financial conditions in the markets, they look pretty accommodative. And so balancing all of those things together, it seems to me likely that the neutral rate has been rising over the recent past. And if you look not just at the Laubach-Williams model, but we have one of our economists in the Cleveland Fed has put forward his own model for star variables, R-star, U-star, and a variety of others of them. And that also has been trending upwards. Those models, both Saeed Zaman's and the Laubach-Williams model, have it around 3.4, 3.5% is what comes out of those. But that's risen a good amount since a number of years ago, kind of pre-pandemic, coming out of the global financial crisis. And so it seems to me likely that to maintain a restrictive stance of policy, we need to keep rates around these levels. And when I look at the overall performance of the economy, it's not obvious that monetary policy should be doing more right now. I think we still want to make sure we've got some restriction to bring inflation back to target. And as we talked about, the labor market, to me, seems broadly in balance. Definitely some places to watch, and if I see more material weakening on the employment side, that would shift my viewpoints. But right now, I see persistence in inflation. We've been above our target for 4.5 years. My forecast would have us staying above target for another 2 to 3 years. So if you add that all together, it's going to be the better part of a decade that we've missed on our inflation side of our mandate. And so I think to maintain our credibility, it's important that we continue to work to bring that down. Now, again, it's a challenging time for monetary policy to balance both those sides. And reasonable people looking at the same set of data can come up with different perspectives on what the right course of action is. But to me, I think we need to maintain some amount of restriction.
If I'm right, you are a voting member now of the FOMC.
I will be in 2026. I like a prepared student. He's got his question written out.
Hi, thank you for having me. It's great to talk to you. I'm Tyler Ressick. I'm from Duquesne University. I'm a senior. And my question is, with increasing isolated private credit events and the SOFR market having spikes above the discount window rate multiple times in October, SOFR, as of today, 2 basis points below the discount window rate, is there liquidity stress in the banking system?
That is a very thoughtful question, and you've gone into one of my old areas. So we can geek out on money markets, which I wouldn't have anticipated that college students would be excited about. So we ended our balance sheet runoff. As you know, we were in balance sheet normalization mode, and at our last meeting at the FOMC, we announced that we were going to end that beginning on December 1st. So this is our last month where we'll be migrating the portfolio down. What the committee has talked about is wanting to maintain reserves at an ample level. We had been above that, what we called abundant, and at times super abundant, as the balance sheet worked its way down from $9 trillion to the low $6 trillions right now. We have seen some pressure in money market rates, as you pointed out. At the around October month end, you saw some of the rates, SOFR, but also the Tri-Party General Collateral Rate, TGCR, which is another good indicator of repo activity, trading above our range. So we have a 25 basis point range, which is now between 3.75% and 4%. You saw some prints above that. The Fed put in place a series of tools, one to help manage rates when they're on the floor, which is called the reverse repo facility. That's a place where money market funds can give us collateral and invest that collateral, and we'll pay them 3.75% on it. At the top end of the range, there's both the discount window as well as a standing repo facility. And our expectation, my expectation, is that if it's economically reasonable, that participants, largely primary dealers and banks, will take advantage of that standing repo facility, and that will help to maintain interest rates within that target range that we want. Periodically, you see swings in the amount of reserves outstanding, whether that be because of Treasury issuance and their general account rising, or whether it be that there's other pressures, big coupon settlements, or what we saw at the end of October was Canadian year-end, and so the Canadian dealers changed their behavior somewhat around that time period. You tend to find that you can have pressures around that. To me, being ample means that you can see periodic pressures, but they'd be temporary and they'd go away quickly. So if you saw pressure, if you saw repo rates broadly trading above the top of our range for a day, middle month around coupon settlements, end of the month around that period, for whether it's quarter end, year end, or just coupon settlements, to me that's normal, and that's probably indicative of us being right around ample. But what I do want to see is I want to see that standing repo facility be used by the dealers. I want to see them taking advantage of it and fulfilling their obligation as primary dealers to help us maintain good rate control by partaking of that tool. So I think the question, if I'm synthesizing your question a little bit, is are we still at ample or have we gone below? Because if we're trading above on a more consistent basis, that could be a signal that we may be trading, we may be moving more towards the scarce part of the regime. The SOMA manager, Roberto Perli, I think had a speech yesterday where he was talking about this, looking at the reserves. There are a number of variables that the desk looks closely at to help determine where we are, and they'll make the determination when we need to begin growing reserves to make sure that we stay in that ample range. And I think from what Roberto said, we're getting, coming out of December, once the balance sheet has normalized, it probably won't be too long before we start re-entering for purchases. So that's how we geek out on money markets.
Hi, I'm Greg from Carnegie Mellon, and I've got a question also pertaining to the end of the balance sheet runoff. Do you think that we can expect the Treasury to now shift to issuance of more longer-term bonds rather than short-term T-bills like they've been doing over the past year?
So that's a great question. That's a question for Treasury. We are their fiscal agent, and we'll help support them in whatever it is that they choose to issue. But Treasury and the Fed are independent organizations. There is some amount of conversation and discussion between the two, particularly as we help them run the payment system, we run their auctions. But that'll be a determination that Treasury will need to make about how they want to shift their issuance portfolio. On the Fed side, what we look at is how are we investing our portfolio. And so we'll have, when our portfolio stops shrinking, stops normalizing on December 1st, to stabilize that, we will be reinvesting proceeds from the mortgage-backed securities. And so there's a question about, would we be investing along the full complement of options that the Treasury issues, or might we be shifting that to focus more in bills? And so those are conversations that we'll continue to have around what the right portfolio structure looks like for the Fed. We've said very clearly that we want to be in a Treasury-only portfolio. It's going to take quite some time to get there, but it is important that we continue, I think, to migrate our portfolio to Treasuries to make sure that we're not having an impact on sector allocation amongst the economy. I think investing in mortgages too heavily preferences the housing sectors vis-a-vis other parts. I completely understand why we did it when we did it, and it made good sense to do it. And over time, we should move to having a Treasuries-only portfolio.
We have time for one more question.
Hi, my name's Jamie. I'm from Carnegie Mellon as well. I've heard, or there are concerns about the potential loss of the U.S. dollar's hegemony compared to other currencies, and further devaluation could exacerbate inflationary pressures. So, is the Federal Reserve concerned about the potential further weakening of the dollar, and how is that phenomenon influencing the Federal Reserve's actions, both in monetary policy and beyond it? Thank you.
So the dollar is really the purview of the Treasury Department. It's not really the purview of the Federal Reserve. It is something that we watch closely because it does impact financial conditions. It impacts the economy. It imports the competitiveness of exports and imports. And so we do follow how the dollar is performing, but it's not part of our policy tool or our objective function when we're thinking about the economy. I think there's been a lot that's been made about the US dollar and some of the weakening that we've seen over the course of this year. But it's important to remember that we started from a place of extreme dollar strength. And so the weakening that we've seen this year has largely brought us more in line with a lot of theoretical fair valuations of the currency relative to other currencies. You've seen some amount of movement, but what I've mostly heard when I'm out talking with various market participants is not that they're getting out of dollars. They're not moving away from it entirely. They're just moving towards a more neutral weight in their portfolio. They want to move to something that's more balanced rather than being significantly overweight, which is, I think, where we had been before. So it's something that we watch, but it's not a real factor in my monetary policy decisions.
Thank you, Beth, for your very informative fireside chat. You've definitely provided a wonderful learning opportunity for everybody, including the students from Duquesne and CMU, that increasing number of the students who have been able to attend. And as always, I have to thank Diane, our organization secretary, who is right there, for putting this together. Because without her, we wouldn't be able to put these events. Our next event is our annual forecast lunch on January 26th at the Fairmont, Pittsburgh, with a panel consisting of Gus Fauché, the chief economist of PNC, Chris Lattimore, private wealth advisor of Merrill Lynch Private Wealth Management, and Chris Bream, regional economist of the University of Pittsburgh's University Center for Social and Urban Research. It's a long title. Details will be available on our organization website, econclubpgh.com, and we hope to see you there. Thank you so much.